Ladies and gentlemen, we have some new shocking information, some new leaked details, a leaked report that shows the Federal Reserve is secretly bailing out the stock market, and that's why we're seeing such a huge rally right now. And on top of this, we're at the beginning of an AI stock market bubble, just like the 2000.com bubble. And this is why I've been talking about we are at the risk of the Federal Reserve and central banks causing the opposite of a crash, but actually a market melt up. So you need to wake up, pay attention to the new details, the new economic data, the new reports we got right now, so you can adjust your investing strategy. So let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, first things first is this, everyone. First quarter economic growth was actually 2%, up from 1.3% first reported in major GDP revision. This is the first reason why we're seeing the stock market rally, because apparently the economy's doing fine. Everything's okay. The economy's booming. People aren't struggling at all. They're spending out there like crazy. Well, just wait a minute. We'll get into another report that shows they aren't, and there is going to be more trouble coming ahead for the economy. But it's quite funny, all these reports, they keep getting these huge revisions months after the fact. Ladies and gentlemen, what we have to admit now is they are cooking the books and making the economic picture look much better than reality. And then all the AI algorithms that trade these reports go in there and buy like crazy. Not only this, but the job market is still performing very, very strong, even after the Federal Reserve has lifted interest rates over 5%. So one specific focus for the Fed has been the labor market. There's currently about 1.7 open positions for every available worker, and the tightness has resulted in a push for higher wages, which generally have not kept pace with inflation. A separate report from the Labor Department showed that initial jobless claims fell to 239,000 for the week ending June 24th, and that was a decline of 26,000 from the previous week and well below the estimate of 264,000. So okay, that's the first reason why the market is performing very strongly right now, because the economy is doing better and unemployment rate is still at record lows. And don't worry, in a moment I'm going to get into that report about how the Federal Reserve is secretly banging out the stock market, but we need to go over the economic data first. Also, another reason why the markets are getting quite hopeful is because of the key inflation measure, which the Federal Reserve prefers, the PCE, and that came in at 0.3%. But look at this, everyone. Spending rose just 0.1% for the month, below the 0.2% estimate, and a sharp drop from the 0.6% increase in April. Now, personal income accelerated 0.4% ahead of the 0.3% estimate. So what that means in plain English is, yes, inflation is slowing, but it's only down 0.1% year over year. So that means in order for the Federal Reserve to get to their 2% mandate at this pace, it's going to take another 2 years. Now, also what this report showed is people are spending much less than they were the previous month. There's been a huge drop from 0.6% growth to just 0.1%, even though their wages are increasing. So that tells me even though the stock market is in mania right now and melting up, the average US consumer is starting to struggle. The report shows the spending splurge is likely nearing an end as consumers released most of the pent-up demand for spending. That's exactly right. We saw a huge spending boom after COVID. People couldn't spend, so they went out there and spent like crazy, and now they've got pretty much all the goods they need, and they're now starting to spend more on services. Though Friday's data showed inflation moving gradually in the right direction, it is still well below the Federal Reserve's 2% long-term target, and the central bank chairman Jerome Powell said this week that the level isn't likely to be achieved for a few years yet. So the central banks on one hand are saying that inflation isn't going to get to their target for a few years, but the markets don't believe them. They think they're actually going to start cutting interest rates in 2024, despite what the central bankers are saying. Now, do I believe the central banks? No, but it is so uncertain right now. And traders are pricing an 80% chance that the Fed approves a quarter point increase at the July meeting, and odds were little changed following Friday's data release. So it's quite clear here, everyone, the Federal Reserve has not done enough. Apparently, the economy is fine. Unemployment rate is at record lows. People are still spending. The stock market is melting up. The housing market hasn't crashed yet. So why isn't the Federal Reserve doing their job and continuing to lift interest rates aggressively? Well, we'll get into that in a moment. Now, what this is all creating is capitulation in the markets, and most investors believe we are now in a bull market. Now, technically, yes, we are in a bull market because the S&P is up 20% from its lows. Also, the Nasdaq is up 30%, but will it be sustained? So most investors believe believe we are in a new bull market and there'll be no recession in 2023. Now, while it's quite clear with the new data we got, we won't have a technical recession in 2023, especially when they keep changing the definition of a recession. But the reason for that is because we have record immigration and also high inflation. But if you actually factored in real growth per capita, we would actually be in a recession. And the only reason why we're having economic growth, again, like I said, because of immigration and because of inflation. If we have economic growth of 2%, but inflation's 5%, really we are in negative growth territory. So CNBC polled about 400 chief investment officers, equity strategists, portfolio managers, and CNBC contributors who manage money about where they stood on the market for the third quarter and forward. So it's quite split here. 61% said we've entered a new bull market and 39% believe this is just a bear market rally. But what do you think, everyone? Let me know down below. Now, also a poll in terms of possibility of a recession. 32% believe there will be one in 12 months from now. So I do think it's highly likely in about 12 months we will have an official recession. 32% believe that. 26% believe the first half of 2024. I could see that happening. 21% say there won't be a recession at all. I don't think that's likely. It's just going to have a bigger lag effect. Within Q3 or Q4 of 2022, 16% believe that, and 5% believe we're in a recession now. But many think the unique circumstances this time around, an unprecedented pandemic which prompted historic fiscal and monetary response, might result in a downturn unlike anything other than history. And I completely agree, but this all comes down to, will the central planners, the central banks, the government, will they let it happen? Because recessions and market crashes were very common throughout the early 1900s and also in the 70s and 80s. But what's happened lately is politically, a lot of people, they've all got their money tied up in the markets now. Your savings is tied up in the markets. Your retirement is tied up in the markets. All your money is tied up in the banks. So if we do see a crash politically, it's going to be very bad for the current administration. So they don't want it to happen. And also we have to agree that this generation is currently snowflakes and they say, oh, look, we can't have anything bad. We can't have any downturns. We all want a participation trophy and they only want the markets to go up. A strategist warned we should not expect a standard recession. This is an unorthodox cycle. And that's right. COVID completely changed the economic landscape. The economy may instead experience rolling recessions across different segments. So let's have a look what these strategists think is the best place to park your money. So the best returns for the rest of 2023, 26% will be short-term US Treasuries, 26% say S&P 500. They say 26% say foreign stock markets like Japan, China, and Europe. 11% NASDAQ, and 11% oil. Now, you have to take everything that these market strategists say with a grain of salt because they're very biased and they also typically underperform the market. And at the end of the video, I'll tell you where I think the best place to park your money will be. Now, okay, up next, what we have to admit that's creating this stock market mania is AI. Now, with all new technologies, this always creates bubbles 100% of the time. Do I think AI is going to change the world? Yes. Do I think it's a revolutionary technology? Yes. Whether we like it or not, AI is going to come, is going to create massive layoffs. It's also going to create huge profits for these companies because they'll be able to lay off huge amounts of workers and they'll be able to charge very high premiums for this new technology. Do I think it's moral? Do I think it's right? No, I don't. But unfortunately, that's what's going to happen. So look at this, everyone. AI obsession powers $5 trillion NASDAQ 100 surge. Now, I do think we are in early stages of this bubble, so I do think it has more legs to run. But like we learned from history through the dot-com bubble and also what we've seen with the cryptocurrency bubble in 2017 when every company just put blockchain and decentralized in their stock description and their stocks rallied massively. And this was the best first half year on record. So traders looked at the glass half full as data showed inflation is moderating. Even if that comes at the expense of growth, stocks extended this year's surge with tech consolidating its leadership amid an ascent of artificial intelligence. Big banks saw their first monthly gain since January after passing the Federal Reserve stress test. In late hours, JP Morgan Chase, Wells Fargo, Morgan Stanley, and Goldman Sachs announced higher dividends. But I'll get into in a moment the real reason why they passed the Federal Reserve stress test. So nearly $5 trillion has added to the value of companies in the NASDAQ 100 since the start of the year, with a tech-heavy gauge defying bubble warnings and jumping almost 40%. The advance in the most influential group in the S&P 500 helped push the index up 16% in 2023. And gains have been even more pronounced when narrowed down to the mega cap space, which has soared 74%. 74% in 6 months? I don't know about you, everyone, but this definitely sounds like a bubble to me. The big seven, including Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla, boosted profits by 14% a year during the decade through 2022. While their combined earnings slumped more than 20% last year, they're expected to recover swiftly. So this is why the market is so bullish on AI, because even if these companies' revenues fall, their profit margins are increasing. And even though all the fundamentals are telling us that the stock market is severely overvalued, well, if you just say AI, everything's okay. Like this, the Warren Buffett indicator. Right now, the S&P 500 is 173% of GDP, and it is overvalued. Not only this, but the S&P 500 price to earnings ratio is at 25, when the mean is normally 16 and the median is normally 14.9. The market's fascination with the power of generative AI has trumped every major issue that could potentially drag down sentiment this year. Recession fears, elevated levels of inflation, prospects for more Fed hikes, geopolitical risks, the debt ceiling debate, and the collapse of a few regional banks. But AI, so it doesn't matter, right? But what normally happens after a huge rally run? Well, traders normally take profits and there's normally a correction, and there is now a lot of bearish bets coming in the market. Still, after such a strong advance, there's growing concern about valuations that has recently spurred a surge in bearish bets against the largest tech companies. Short interest as a percentage of shares available to trade is near 12-month highs for Microsoft, Tesla, and Amazon. Now, they go on to report what's helping this tech rally is the 10-year US Treasury yield is still subdued, as at 3.8%, down from its high of 4.5% early in 2022. So it's quite clear the Federal Reserve is not doing enough. And let me now get into what we've all been waiting for, this report that the Federal Reserve is actually secretly bailing out the banks and the stock market. And that's why this rally is going to continue, because the Federal Reserve will not let a crash happen now. It's quite clear the stock market has become a complete Ponzi scheme. And let's get into this report. So look at this, everyone. Federal Reserve banking bailouts reach a new weekly high of 103 billion. What the heck is going on, everyone? The Federal Reserve is bailing out the banks every single week to the tune of 100 billion. That's right, $100 billion is going to the banks every single week. But we don't have enough for healthcare, we don't have enough for schools, we don't have enough for roads, we don't have enough for homeless, we don't have enough for veterans, but the banks are getting $100 billion in bailouts every single week. This is why inequality is out of control. This is why the systems are completely broken. This is why politicians that are on salaries of $100,000 are retiring with portfolios in the tens of millions. It's become a complete Ponzi scheme, everyone. Because what's the definition of a Ponzi scheme? Well, you need people to make money, and you need more and more people coming into that Ponzi scheme for it to keep going. Well, that's how the US monetary system has become a Ponzi scheme. They print money out of thin air, then they charge you interest, and where's that interest going to come from? Well, they need to keep on printing money. Also, economic growth is now created by immigration, so they need more and more people immigrating into the country and also creating debt. They need more and more debt coming in the system and more debt created to also pay off the interest. But okay, let's dig a bit deeper into this report. But not only this, I've got more proof to show you. So the United States Federal Reserve's emergency fund for embattled banks has seen its high level of distressed asset redemptions since its inception 3 months ago. What? I thought the banking crisis was over, everyone. I thought the US banks just passed the Federal Reserve stress test. Well, yeah, that's right, because they're getting unlimited money. The emergency lending program, known as the Bank Term Funding Program, was introduced in March amid the United States banking crisis, which saw the collapse of Silicon Valley Bank, among others. The fund essentially is aimed at backstopping banks and other depository firms. So what this facility simply is, all these banks that have had huge losses on these bonds, also these commercial mortgage-backed security loans, they just take it to the Fed, sell it to the Fed for whatever price they want. This is outrageous, everyone. If you or me make an investment, we can't go sell it to the Federal Reserve at whatever price we paid for it. This shows we are now in a two-class economic system. The milestone figure means the Fed is still bailing out banks despite its attempts to reassure investors that the banking crisis is over. And market analyst Joe Consorti is now saying the Fed's shadow liquidity is propping up risk-taking behavior across markets. That's right, everyone. Just go all in the stock market now, because it's quite clear the Federal Reserve and the central bankers won't let a crash happen. He tweeted here, emergency loans from the Fed's BTFP facility rose to 103 billion this week, a new high. No surprises, usage of the program rises and banks' US Treasuries losses are erased. The S&P 500 rises too. So he also says here, BTFP by the flippin' Ponzi. Now, this is leading to speculation. We all know there's a huge commercial real estate market crash happening right now, that the Federal Reserve will start to buy these distressed commercial mortgage-backed securities as well. The Fed will definitely have to create a new facility to buy distressed CRE loans and maybe even commercial mortgage-backed securities. According to Reuters, US banking regulators have been asking lenders to work with credit-worthy borrowers that are facing stress as commercial real estate lending remains under pressure. I'll say it's a little worse than that. Furthermore, the Banking Term Funding Program peak has come the same week that the Federal Reserve announced its banking stress test results, passing the top 23 lenders in the country. Why even bother doing a Fed stress test right now when we all know they're just going to bail them out anyways? The Telegraph reported that it is a wider problem after trillions of dollars of such central bank money printing worldwide. The chickens are coming home to roost, with banks drowning in debts amid rising interest rates. And that's exactly right, everyone, but will the central bankers just kick out the chickens? So okay, we know the Federal Reserve is bailing out the banks, but they're also turning the money printers on again as well. So this is the M2 money supply run. And we've all been very concerned because the M2 money supply has been falling and falling rapidly, but now it is starting to tick up again. And the M2 money supply just in the past month from April to May, and this is lagging data, I'm sure the new data is going to show it's surging again. It's gone up around 150 billion. But not only that, this is also the Federal Reserve's balance sheet. We can see here they did huge money printing again in March to April, increasing their balance sheet by around 400 billion in just a matter of weeks, and it is still higher than its February low. So everyone, I know what you're thinking, well, okay, what does all this mean for you in simple terms? What this means is, everyone, the stock market, the banking system has become a complete Ponzi scheme. The Federal Reserve's bailing out the stock market by bailing out the banks. They're printing money again in the shadows, unlike the mainstream media is trying to tell you. So okay, what can we do to position ourselves to profit from this market rally? Well, I think the stock market rally has been overrun. I think there will still be an increase over the next 6 months, but I think there's going to be much better returns in Bitcoin, because whenever there's a market melt up, a lot of FOMO, I think a lot of traders are going to take their profits from the stock market, put it into Bitcoin. Also, if the new Bitcoin ETF does get approved by BlackRock, also Fidelity is trying to get one approved as well. So if a Bitcoin ETF does get approved, Bitcoin is going to skyrocket, because what's really holding Bitcoin back is a lot of institutional investors and a lot of sophisticated investors. They don't want to buy Bitcoin because it's too risky putting their money on exchange when the bank could freeze their transaction, or the exchange could take their money and do risky bets, or the exchange could get hacked. So it's too risky to put their money on these crypto exchanges. But if a Bitcoin ETF does get approved, we're going to see a wave of money come in. And I expect Bitcoin will hit at least 150K in the 2024 bull run. Now, also a hedge against this in case we do have a severe recession and the central banks do actually, hopefully if a miracle happens and they do actually stop bailing out the markets and we have a stock market crash, well, that's what gold and silver is there for as well, to hedge against this scenario. And that's why I love the Trinity portfolio so much, is because you can get the gains from the market melt up, but also protect yourself against the economic headwinds that will be coming. Now, if you're wanting to learn more about how to build wealth and master the cycles of gold, silver, and Bitcoin, you can click the link in the description below. This course is 50% off right now while I'm in the pre-launch, and once the course is finished, the price will be doubling. So everyone, unfortunately, I have to admit the stock market is in a bull market again. We will probably see a rally for the next 3 to 6 months. The economy probably won't fall in a technical recession this year, but I do expect we will see major pain in 2024. But everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.